I'm Hans Lee, and this is The Rules of Investing, a podcast that gets inside the minds of leading investors, economists, and industry experts, brought to you by Livewire Markets. In the last episode, you heard from Coda Capital's chief economist, Bridget Leckie, who explained how moves in the global economy shape decisions for investors and allocators. This week, our subject is about Australia's big property problem. For instance, did you know that 3 of Australia's capital cities rank in the 10 most unaffordable cities in the world? Sydney is the world's second most unaffordable city, coming second only to Hong Kong. Melbourne was ranked 7th, and Adelaide tied with San Francisco in 9th place. So, how can we boost housing supply and make property more affordable for Australians? To find out, our guest this week is Andrew Schwartz, the Group Managing Director and founder of Qualitas. He's been working in property markets since 1997 and founded Qualitas in 2008. The firm now has $8.9 billion in funds under management, making it one of Australia's leading real estate investment managers. If you're an Apple Podcast or Spotify user, don't forget to subscribe to the podcast so that you don't miss an episode. If you're a Livewire subscriber, you can hit the follow button at the bottom of the wire to be notified when new episodes are available. If you're not a Livewire subscriber yet, you can head over to livewiremarkets.com. It's free, easy to register, and you'll get access to insights from the leading investment minds in the country. All right, let's get on with the show. Andrew Schwartz, welcome to The Rules of Investing.
Hi, Hans. Great to be here.
Andrew, residential property prices have continued to soar in Australia this year, despite many experts predicting we would see a mortgage cliff as rising interest rates took their toll. How would you characterise the last 12 months?
When I think about property, and in particular, we'll go with residential property over the last 12 months, I think it'll go down as one of the less exciting years that we're going to think about in the market when we reflect on the years that have gone by. It started pretty well. There was a lot of momentum in the market. We saw a lot of price gains, particularly off the back of calendar 2023. But as we're approaching the end of 2024, it's quite clear that markets are starting to slow down. A lot of that momentum is coming out of the market. And I think overall, when we think about what were the years that were absolute highlights of residential market, I'm not sure 2024 will be the one that's featuring highly for us.
Okay, so if it was a little more boring in 2024, does it get more exciting in 2025?
I think it's getting very exciting
Okay.
in 2025. And there's many reasons for why I feel that, but in particular, residential property is really affected by supply and demand and interest rates. And I think when you look at each of those various factors, you do see a market where Australia is caught short on the supply side at the moment, and it's been very hard to get supply into the market. We have quite significant demand coming into the market, and we've had a sustained period now of relatively high interest rates. So I think, Hans, a lot of one's views about 2025 will be dependent specifically on how you feel about those things. But I think it's going to be a bit like watching a thriller movie and having your bucket of popcorn and you're going to be chewing on the end of it, watching how this all plays out. It's going to be absolutely fascinating, and I say it with excitement.
I won't ask you which thriller movie. One thing I find interesting about Qualitas and the work you guys do specifically, around 80% of your investments, and I remind listeners and viewers, we're talking about $9 billion in assets under management here, but 80% of that is weighted towards the residential property market in Australia. So how is this investment reflected in your portfolios, and why do you have such a large allocation towards that residential property market as well?
That is correct. 80% of our $9 billion of funds under management is in residential market. And as an investor, absolutely love investing into sectors that we think have very significant tailwinds and also price stability around it. So at foremost, it's important to remember with Qualitas that we are a private credit provider into the real estate markets, and 70 to 75% of all of our assets are in the form of loans, and 75% of all the underlying assets are residential. So it is fair to assume that we love residential. But the thing that mostly as CIO of the firm that I have to stay focused on is that prices aren't going down. So for me, it's less of an analysis of exactly do I think prices are going to be increasing by 5 or 10%. More of the analysis is around price stability, ensuring we can get our loans back, ensuring that there's enough value in the underlying assets to recover the interest that we charge the borrowers on our various loans. So we do think residential has very significant tailwinds. I'd be happy to further explain that.
I was about to say, what are those tailwinds in your view?
Those tailwinds are really around the excess of demand over supply in the Australian market. And what you see is that, vacancy rates on a national basis are around 1.2%. So just to create a perspective around that, if you owned an apartment building that had 100 apartments in the building, and I asked you, Hans, how many are vacant at this point of time, and you said to me, one, maybe two, I would think to myself, the building that Hans owns is full, because that one or two is actually transitionary. It's somebody's moving out on that day for whatever reason. And so really, when you're down at 1.2%, you've got virtually no vacancy in the market. At the same time, it's hard to get fresh supply to come into the market. So when you think about it from a demand and supply point of view, you would say, and this is economics 101, I've got excess demand. It's hard for me to put new supply in the market. And therefore, I believe that there's price stability that must be underpinning that market given the excess demand of the market at the moment. So from a private creditors credit perspective, that's great tailwind. It's great, a great investment thematic for us to be investing behind.
Let's go back to the macro if we can. I think one of the big stories around housing, particularly this year, is around population growth, right? It's continued to put so much pressure on housing availability, particularly in the rental market. How many new homes does Australia actually need to build in order to increase those vacancy rates?
The answer is the government has come out with a policy of 1.2 million homes over the next 5 years. And Australia at the moment isn't supplying, anywhere, around that sort of number. So it's roughly around 240,000 homes a year. At the moment, if you look at calendar 2024, Australia as a whole supplied about 175,000 dwellings, so well short of the targets that have been set. And interestingly, even in the peak years, Australia peaked at about 215,000 dwellings, so still short of where we need to be. So we are running short. Again, it goes to the thematic that I explained earlier in regards to excess demand over supply. But they are the targets that have been set by government and by the industry.
So if I think about that then, 240,000 homes a year on target at least, whether we get anywhere near that target is a whole different question. That says to me that's a lot of building that needs to be done and a lot of projects that have to be financed and have to be worth the builder's while and worth the builder's profit to make it work. So how can these projects be financed?
Well, the financing we estimate on those projects is about $250 billion of projects. And traditionally in Australia, those projects would have been financed by the 4 major trading banks. And, in more recent times, groups who are alternative lenders, I'm going to say Qualitas at this particular point, but groups who are alternative forms of credit in the market are providing very viable solutions to developers to meet that capital need. But the truth of it is we all need to lean into it. It's a very significant amount of capital. And I think that, the industry's evolved. You've got groups like ours that have pension funds, sovereign funds, superannuation funds who are investing behind us and really being able to provide that very valuable capital into the industry. But it is $250 billion that's going to be required in order to get these projects underway.
So we've talked a little bit about housing availability. Can we talk now a little bit about housing affordability? I kind of mentioned at the top of this program that recent stats showing, obviously, that Sydney ranks second most unaffordable city in the world, Melbourne ranks 7th, Adelaide is 9th, Brisbane and Perth really coming through as well. Do you see the affordability situation improving or getting worse across Australia's capital cities?
I don't see it improving. I was reflecting on the fact that I'm a Melbourne person, very proud of that, I might add, and I've been coming to Sydney literally for 40 years for business, and I can remember as far back as the 1980s and 1990s meeting colleagues of mine in Sydney who have always complained about house prices and how they're jumping. And, it's very hard to obtain the actual property that you want to obtain. And that's been a very consistent story. In fact, I never remember somebody saying housing's cheap and, we should be buying as much of it as we can because look how cheap it is. And so I think affordability has always been an issue in this country. I think we've got a very significant issue on our hands at the moment, which is why I said 2025 is going to be incredibly exciting, because at the moment, construction costs have risen some 40% over the last 3 years in Australia. And unfortunately, and this is somewhat a city-dependent comment I'm making now, but as a generalisation, housing prices and apartment prices in particular have not gone up by 40%. So groups like ours see a very large volume of project feasibilities where developers would like to get their projects financed. And one of the key measures for us is really around the margin that the developer is earning on the project. And I don't think about margin as a developer making, money per se. I think about margin as safety for error. Like how much could we afford for prices to wind back, or how much do we think about construction costs increasing, but yet our loan would still be okay into that particular situation, particular project. And what we've found is up until about the last 8 to 10 weeks, generally residential off-the-plan pricing has not increased anywhere near the 40% rise in construction costs. And I think therein lies one of the biggest impediments that there is to getting more supply, particularly high density supply, into the market. And that further then leads into a discussion around interest rates. And the problem with interest rates is it gets to the heart of your question, Hans, which is around affordability. And so I do think that there's a real juxtaposition that's going on at the moment. It is going to be incredibly exciting as to how this plays out over the next 12 to 18 months.
Is this all about, changes to policy? Is this all about government stepping in and starting to underwrite those projects? I guess what I'm saying is, are they the ones who should be taking up most of the burden to make the crisis easier?
I think government has a role to play in easing the situation, but I don't think it's purely going to be about government policy. I mean, the areas that government can really help out in is land availability, obtaining your development approval, zoning, providing some element of tax relief. I think the most recent stamp duty changes in Victoria is a very big change in government policy. My expectation is that it will lead to a very large pull forward of projects that otherwise would have been difficult. I feel there's a role for government in rental subsidies, first home buyer grants, social housing. There is an enormous amount of things that the government can actually do. However, I don't think this is all down to some sort of government silver bullet resolution to the Australian housing issue, particularly around supply. I do think the biggest impediment revolves around off-the-plan residential prices that are just not kept up at a level that is sufficient for the increase in construction costs in a post-COVID environment. And so really what we're down to, when you want to think about the volume of dwellings, particularly as you deal with apartments, is really around, do you believe that apartment prices could rise by some 20% from where they are at the moment to have kept pace with the rise in construction costs, so that developments are now feasible again and you can get more volume into the market. And I believe that is probably one of the biggest impediments that there is to getting supply into the market. Depending on where you are, construction is also a factor because on a state-by-state basis, that can very much differ.
On apartments, very quickly, you've jogged my memory, and I think this is worth asking, especially in the context of apartments. I know that talking about the Australian housing market as a monolith is perhaps a bit disingenuous because it's different by city, it's different by street, it's different by, in some cases, apartment number. How different or how is that nuance between, say, established apartments, right? Your building's been up for 50 years, versus, say, off the plan, where there are a lot of projects, even in my local area, a lot of stuff that's going up. There's more cranes in my local area than I've seen in ages. Is there a differentiation between the two?
It's a really, really good question because people talk about property as if it's one thing.
Yep.
Right, and it's not one thing, right? You've got, several major cities within Australia. You've then got CBD, inner city precincts versus house and land on the outer. And then you've got difference in each state dynamics around labour costs, construction costs, land values. So you cannot talk about property as one specific thing. So I certainly acknowledge that particular point. When it comes to established housing, now whether that's built form apartments or whether we're talking about traditional suburbs and traditional house and land, you're really driven by the psychology of interest rates and affordability. So if people believe interest rates look to be coming down, then I think that there'll be an element of some buyers in the market who want to jump ahead of that and say, look, before the cost of capital decreases, people will start to be able to have bigger loans and mortgages. We want to get ahead of that, and we're going to start purchasing property. And I really think that's less about supply and demand per se. It's much more driven by interest rates and the psychology of interest rates. Off the plan apartments is a bit like when you buy a new car. It's nice and shiny and it's beautiful, but that as soon as you take it out of the showroom, it's probably got a little bit of a different value to exactly the contract price that you may have signed. And so that's really around the ability to offer something that is brand new, never been lived in before. It meets your requirements and amenity, and the ability to be able to sustain a higher price for really that project feasibility. So I think that really comes down to more around the construction costs, the design of the building, the client, the resident that you're actually targeting for the building itself. They're more the areas that will really drive the demand for it. But having efficient construction methodologies, having great government policies, having the right interest rate settings certainly go a long way.
Andrew, let's return to the macro now if we can. What economic signals do you pay attention to in order to get a sense of where you're going to put investments to work?
I look at a lot of different economic signals, but the one that I'm most focused on is really around interest rates, because for us, interest rates is a form of cost of capital. And as I was saying earlier, I do think in a decreasing interest rate environment, asset prices tend to go up because your cost of owning those assets are reducing, so you can afford to pay more for underlying assets. And so for me, a lot of the analysis here is really around what future expectations are in regards to interest rates.
Okay, well, what are your future expectations for interest rates?
I sort of set that question up, didn't I?
Yeah, I think you did.
Look, I have not been for a long time in the camp of we were going to see large interest rate falls and the markets were peaking. I think, honestly, it's not a comment with the benefit of hindsight. I was always, for the last 12 or so months, in a view that cuts are going to take longer. We probably had one rate rise on the upside, but potentially, 2 or 3 on the downside. That I didn't believe that interest rates were going to go anywhere near back to those emergency levels of 10 basis points. It continues to be my view that I think that, we've had 13 interest rate rises really as a result of inflationary pressure that's been caused by government spending in a post-COVID environment that I think was entirely appropriate for, that particular moment of time. But this last mile of inflation, as they call it, is going to be really hard to break. And although in the most recent numbers where you had inflation down at that 2.8% level, which is clearly within the 2 to 3% band, when you take out all the anomalies and one-offs and you look at the trim mean inflation, it was certainly in that sort of mid 3% type range. And I just think that's going to be quite a hard area to get down. Now, one of the main reasons for that, and something that I really look at, a signal that I look at very closely, is around the labour market. And we've just, in the last week or so, got the labour numbers come through. You can see that we've had, interestingly, continuing tight levels of labour conditions within Australia. I was pleased to see the fact that we haven't had a lot of wage inflation. That's something that personally I'm really carefully looking at, because if you continue to get wage inflation, it's inflationary. And therefore it's something that, we all do need to keep a particular eye on. So thankfully, I had felt that was more modest relative to my own expectation. But the fact is that labour conditions continue to be very tight in this country. And so whilst they're tight, I think we're going to operate at elevated levels of inflation. They tend to go hand in hand with each other, whilst inflation is hard to break the back of, particularly services inflation, which is what the data is showing you at the moment. I think it's going to take longer to get back into the preferred range of the Reserve Bank. So I personally believe we've had 13 interest rate rises. I can say that factually. I personally believe that rates are going to be higher for longer, and we all need to psychologically adjust into that new environment. And if I'm wrong, it's certainly, in my view, not going to be, actually I should never use the word certainly, but I don't believe it's going to be 10 interest rate cuts or anything like that. We might see a couple of interest rate reductions to really stimulate the economy.
Yeah, there's never such thing as a complete certainty in financial markets. Last question on interest rates before we move on to a different macro topic. I am often reminded of a quote from one of your fellow property investors, actually, Chris Benningfield at Key, and when he did the Signal or Noise property show last year, and he kind of made this point about, well, if you want to increase supply, drop rates to zero. Is the answer to increasing supply and increasing builder activity just simply drop rates to zero?
I think there's a lot of truth to that particular comment, but it has economic consequence. And there is no doubt that if you really want to stimulate the next round of the housing market, it is about dropping the interest rate, because the cost of capital is such a big factor in project delivery when you're adding up all your cost of land and construction and consultants' fees, and of course you've got cost of finance there as well. So there's a lot of truth to that particular point. However, the problem with dropping interest rates to that sort of level is that one of the measures that our central bank, Reserve Bank, is very focused on is the wealth effect of housing. So the more people's houses are worth, the more that they feel wealthy and the more they go out and consume. And so one of the things that's happening at the moment is, and you can see this coming through the data and the numbers, is that with interest rates where they are, we're actually in a per capita GDP recession. So you would have seen the most recent GDP numbers have Australia running at about positive 1% per annum, but you also know that migration is running at levels of between 2 and 3% per annum. So if you take the migration effect out of GDP, we're actually at negative 1%, and the economy is moving at a relatively slow speed. It's equivalent to the recession of 1991, which was something I remember very well, having been in finance markets at the time, and it's
the recession Paul Keating said we had to have.
The recession we had to have, and it's really equivalent to those sort of levels. And so you could raise an argument that given the economy is so slow, why doesn't the Reserve Bank actually start reducing rates? We have been 2.5 years in negative per capita GDP. And my personal opinion is they're really worried about the wealth effect. They're worried about housing really inflating as a result of interest rates coming down. So I think that'll be something that, would be very hard to really try and have that type of outcome, even though I think it would absolutely stimulate in a very significant way the housing market.
Yeah, absolutely. Let's move, if we can, to a different macro topic. And in researching for the Signal or Noise property show, which we did this year, which I'm happy to say we had you on and we enjoyed having you on very much. One stat that I came across was really interesting. It's from the Housing Industry Association, suggesting that this national shortage of tradies, the number of people who we've actually got to get to build the homes, is worse than at any time during the pandemic or even before the pandemic. I think the figure was something like 80,000 or over 80,000 tradies are needed to fill that shortage. So with that said, what's your view on the building shortages, the delinquencies, that conversation, and do you think the worst has passed?
I do think the worst has passed. I believe that, and now I'm really focused on commercial construction contractors as distinct from volume house builders. And I believe that in all likelihood, if you were going to go bust, you probably already have, right? Given we're 3 to 4 years post a COVID environment, you've had all the issues of inflation, cost increases, supply side, logistical issues of getting raw materials to site. You've had delays in payments. You've had work from home and people not being able to get labour onto building sites. With all of those issues, if you've managed to get this far, the chances are you've also repaired your balance sheet. You've been able to find new projects and actually price them profitably and re-establish your businesses. I'm always scared to say those sort of comments because I'm sure I'll go back in, tonight or tomorrow and open the front page and sure enough, there's going to be some news of something. But honestly, I think for really the most significant people, they really have re-established, most significant contractors, they really have re-established themselves. But depending on where you are, your point is well taken, right? If you're in Queensland as an example, very large infrastructure spend, very hard to get labour to site. In Queensland, particularly southeast Queensland, where Qualitas is relatively active there, there really are only a couple of what I would call strong tier one builders. Now I've probably upset an entire industry in actually making that comment. But the truth is, whether you're tier one, tier two, perhaps the top of a tier three builder, the tiers meaning your size, it's hard to get labour. And so much so, they're knocking back work. And I would say that's one of the biggest impediments with construction companies is actually being able to get the labour that they need in southeast Queensland through the subcontractors. I don't think Sydney is very different to that situation, perhaps not as chronic as southeast Queensland. But one of the things we're finding in Sydney is very large developers have said the pricing through tier one or tier two third-party contractor work is just too expensive for us and we're going to build it ourselves. And as a financier, that's something we need to really deeply think about because we tend to like the risk separation that comes from third-party construction companies, but they've not been able to readily achieve it. And you do find the biggest and the best developers are now owner builders themselves. Victoria is a little bit different. Victoria's always is always different for its own reasons, but Victoria is different because it's got quite a vibrant tier one. It hasn't had the same level of demand that certainly New South Wales and Queensland has. And the builder you can readily contract with a tier one, tier two builder, and there's more price. This is not a Melbourne and Sydney thing, Hans, but there's more price predictability around. Construction contracts. You may not like the price that you're getting, but it's certainly going to be very predictable.
So putting this all together then, which areas of the market are you most excited about? Are you most thrilled about, to quote something that you said at the top of this program? And I guess conversely as well, where would you be avoiding over the next 12 months?
Well, I'm a real estate fundamentalist, been investing in it for a really long period of time. And for me, I continue to really like those fundamentals that are coming through the real estate market, particularly when I say that, I'm talking about the residential market. And I really like the tailwinds. You know, I love investing in markets where you've got excess demand. It's hard to get supply into the market. I also think about real estate as a store of wealth. Bitcoin is, not that I'm going to profess to be the Bitcoin expert, but Bitcoin's run to $90,000 US since I last had a look. You know, a lot of our investors, clients, friends, you know, have positions in gold because they view gold as really being a store of value. I actually really believe residential is one of the best store of value that you can actually consider. Personal opinion, not financial advice, but that is my personal opinion, because in a lot of these cities, you take Sydney as an example where you're bounded by mountains and water. You can't actually produce any more land. You do know that our population is growing. Actually, I was reflecting the other day on the fact that, showing my age now, but when I was at university in 1982, I remember the headline of the newspaper saying that Australia's population has hit 15 million. So 2024, right, that population growth is now, as you know, 27 million. The ABS is saying by the time we get to 2061, the population of Australia will be 40 million people. So most 50% of all Australians live in three cities, Sydney, Brisbane and Melbourne.
And they all migrate to those cities too.
And 65%, that's right, 65% migrate to those three cities when you have migration, and you've got a lot of interstate, which is maybe what you mean, where there's a lot of interstate migration, particularly from the southern states up to Brisbane as well. So they don't make any more land, and you know that over long periods of time that more and more densification is happening within the cities. You know, if you look at house prices from 1981, when it was 15 million people, to today, the median house price has gone up 17 times. 17 times, right? And if you say, okay, if I look forward now to 2061 with a population growth of 40, and you have geographical constraints, then for me, a beautiful store of value is buying land in areas that you know are going to be more and more densified over long periods of time. So personally, I find it hard to move away from that. I do say it with a bias because that's what I've been doing for many decades, but that is, you know, how I think about residential and particularly around store of value.
Terrifying, I tell you, terrifying. But in terms of geography, just to come back to those areas, the areas of the market, is it necessarily a Sydney preference over Melbourne? Is it a Brisbane preference over Perth? Can you break down that opportunity set, I guess, for us by city or by region, if you possibly can?
Look, I do like all the cities. For this is not me trying to play peacekeeper
Earn the
here.
keys to the city of Perth.
Yeah, peacekeeper to interstate rivalry. But I do like all the cities for differing reasons. It's hard to go past Sydney. Beautiful, one of the most beautiful cities in the world, but also one of the most unaffordable cities in the world. But for all the reasons that I said, I don't think that we're going to be turning around in a year or 5 years and saying Sydney's cheap, right? For 40 years, I have never heard that conversation being made about Sydney. And I look at some of the prices in Sydney compared to Melbourne and Brisbane. You know, in Melbourne, we talk about premium being at $25,000 a metre and that being exceedingly expensive. In Sydney, you talk about $60,000, $70,000, $80,000, $90,000, $100,000 a metre for waterfront property. In terms of per square meterage rates, and that is now the norm. And so I don't think that's going to change. People want to live in the beautiful city of Sydney. Brisbane really has climate and affordability going for it very much. And because of the tight conditions that we've been talking about, has also been experiencing rises in their rental yields as well. And so I think as we have an aging demographic population, there's a lot of natural drivers for why people, will continue to look to southeast Queensland. In fact, I think anything from that northern New South Wales corridor all the way up to the Sunshine State is really set up for a multi-decade long-term growth. And I have to talk about Melbourne because that's where I'm from. And I believe that Melbourne will always be a very strong manufacturing and services hub, fantastic living conditions, and also, it's lagged Sydney to some extent. It's lagged the Brisbane market as well. And I think at the moment has a real affordability angle to it. And I do believe, this is a personal view, that it will play catch up to Sydney and Brisbane because it has to, for all those supply and demand reasons.
All right, we've moved to that part of the podcast here, ladies and gentlemen. We have our final 3 questions. These are a little bit of fun. They're meant to be a little bit of a thought experiment. So here we go. What is one thing, Andrew, the market is getting wrong today?
I generally think the market actually gets it right. And I try and not go against the tide of a market, both in terms of assets that are increasing and likewise assets that are decreasing. So I'm not taking the easy option, but I'm a believer in efficient market hypothesis. In the long term, it really actually gets it right. And so that's going to be my answer to your question.
Fair enough. What is a story of a big loss or a big win from your investment career? You've already alluded to a few times in this podcast. You've been doing this for at least a little while. What's the story of a big loss or a big win from your investment career, and what did you learn from that?
I think that real estate, and I know they're cliches, but they're absolutely true, is all about timing. It's in the buying and it's in the timing. And so when I think about some of the best real estate investments that I've made, it really was in the depths of the most uncertain times. Investors capitulated. They forgot about the fundamentals of the underlying real estate that they had ownership of. Perhaps they had unfriendly capital structures that were sitting behind them. They couldn't take advantage of time being their best friend. And I think that you've got to remind yourself of those fundamentals and really invest into those moments of time. And they can be deep value. They can give you many times returns, but you do need to have conviction when you're finding yourself in those positions. And so when I reflect on 40 years of investment, I think that there's these very short pockets of time. In most of our careers, they only happen about 2 or 3 times in your entire investing career. But when they present, I think you absolutely need to back your conviction on those sort of things. My worst investments, I would say probably, this is more in a personal capacity than certainly in a professional capacity. And it probably relates to when I was a younger investor, but just investing with friends. When someone says, I've got a great idea, you haven't really done a lot of background study or due diligence, certainly not what we would do in the firm that I'm the CIO of, because we're used to literally writing 100-page investment papers and looking at it every which way. But it's the investment where someone says, I've got this great idea and you should come in and you should invest with me. And the few times that I've done it, I think I've learned the same lesson over and over, that you just can't replace detail, due diligence, careful consideration. Get behind that. Don't go in with a fad and a friend, and it's not the right combination.
Buy when others are fearful, and don't listen to your friends. I got it. That's the story of that. All right, last question, sir. Normally for this last question, we ask about the stock that people would buy, but of course you are a property investor, so I'm going to actually ask you this instead. If you had to choose a capital city in Australia to focus Qualitas' investments on over the next 5 years, which would it be and why?
I'm going to go, you're really pushing me on this interstate politics, I can see. I'm going to go with Sydney. And I say that as well because 80% of all of our investors are institutional, and the vast majority of those are based offshore. And so when they look at Australia as a whole and they talk about where do they feel safe and they see significant upside, Sydney is an international gateway city. And I think we'll always benefit from that particular level of tailwind. I love long-term investing. Time is your best friend when it comes to real estate. So I'll go with Sydney. I think it's hard to look past, but I do think there's significant merit to other cities, but you've cornered me down to one, so I'm going to say Sydney.
Fair enough. Hey, Andrew Schwartz of Qualitas, this has been a wonderful conversation. Thank you very much for joining us. Hope we get to do it again soon.
Thank you. I enjoyed it very much.
And thanks to you for joining us. We hope you'll join us again next time for more in-depth conversations with the very best in finance. Until then, goodbye.